Fascinatingly, China has outperformed dramatically. You just look at KWIB's performance, versus Nasdaq or Tesla or the S&P. So, isn't that ironic? Getting the West completely out, and then whoever was convicted enough, like yourself and like us, we knew these businesses. Yeah, full self-driving could be an unbelievable source of economic value creation the world has ever seen. The system stress increases exponentially as, let's call it, the 10-year yield in the U.S. increases. How does that work when Fed fund futures are above 5% today and the 10-year is at 3.5%? That's 150 basis point inversion, the likes we've never seen. So now you've got a problem. Okay, so say they print money overnight and they have to finance a $5 trillion deficit. Well, now you've got a potential banana republic on your hands. Yeah, Bitcoin, if it was accumulated by central banks, that would be critical. They need to own all of it. So the ultimate money dilemma is a threat to the US dollar reserve system that threatens a lot when it comes to US hegemony. We think that there is a greater than 25% chance by the end of January 2023 that the US is in a bona fide military conflict with Russia and or China.
Isn't the more likely outcome with the higher probabilities for 2023 that we actually get peace in the Ukraine? Trying to think from their perspective, like if you are Russia, if you are China, what this conflict in Ukraine has really shown is that you need to kind of get independent from the US financial system. All right, Michael, it's really great to have you here on the channel. Today, we're gonna cover a whole lot of topics ranging from macroeconomics. You're a fellow Tesla investor as well, so you're also in the EV industry. And we know each other from a previous conversation also about NIO and Tesla as well. And then maybe talk about some other topics as well, like emerging markets, software businesses, and just in general, your thoughts about investing in this quite critical time frame. And I just discovered you again on a Twitter space the other day, and I thought you had some really, really thought-provoking things to say. And so, that's why I set up this recording today. And let's dive into it. Maybe you can just briefly introduce yourself, like what are you doing? What's your background? We're both not actual macroeconomists, right? But I think it's super relevant this time.
I couldn't agree with you more, and thank you, Marcel. It's great to be on your channel. So my experience, I've been in markets for 26 years, and historically, my experience and my background and training is in bottoms-up investing in primarily technology companies and software businesses, and but at times, we're all macro investors, and if we're not, we're certainly doing a lot of work to understand it, and that's one of these moments is what we're experiencing today, all across the globe, especially in developed markets. You've got central banks in all developed economies raising interest rates, and from a zero interest rate policy all the way back to the great financial crisis, for 13 years in the developed world, we've had zero interest rates essentially. And the mechanisms that has created in certainly private and public pension plans around the developed economy, and also the insurance industry, has had significant implications regarding the stress on the system. So essentially, when rates are zero and you're a pension plan, regardless if you're in the United Kingdom or the US, by the way, about 2 months ago, the stress in the United Kingdom private and public pension system was so significant that overnight the central bank had to pivot from quantitative tightening to easing, as they, within 3 days prior, raised overnight rates 50 basis points. So that mechanism we've never experienced it. And essentially what happened, there was a day, I believe it was a Monday in October, that gilt rates, 5-year gilt rates, increased 50 basis points in the span of one trading day. The largest one-day increase in gilt yields in the financial history of the United Kingdom. And that includes post-Bretton Woods, where stresses on the pound were significant, to the extent that in 1982, famously, George Soros betted against the pound, and the pound dropped, I believe, 2/3 of its value in the course of a few weeks. So that was about to happen again. And because of that, central bank in the United Kingdom, Bank of England, pivoted overnight, where 3 days prior, they were tightening liquidity. So that paradigm is being felt all across the developed leveraged world. And that's United Kingdom, that's the entire European Union, that's the United States, that's South Korea, that's Japan. There's significant leverage, orders of magnitude crazier today in the system, the dollar-based system in the developed leveraged world. Orders of magnitude crazier than the peaks during and after World War II. World War II, famously, coincident with the FDR's announcement on, I believe it was December 8th of 1941, declaring war on the Empire of Japan. Coincident with that, the central bank of the US, the Treasury, and the Fed at that time issued a statement, and in order to essentially fund the war effort, they were pegging 3-month Treasury bills at 25 basis points, and I believe the 5-year Treasury note at 2.5%, in order to fund debt to GDP at that time of, before the war, US federal government debt to GDP was 70%. And from 1941 to 1946, that increased from 70% to 125%. And by the way, today we stand and federal government debt to GDP, and that's notwithstanding the off-balance sheet obligations, the entitlements, the Medicare, the Social Security, which probably doubles this ratio. Debt to GDP today is 125% again. The problem is the leverage. That certainly is a problem. The same leverage ratio at the peak of federal deficits in 1946. The corporate system, the corporate debt to GDP is 85%, and household debt to GDP is 75%. And those ratios were below 20% in 1946. So, and this, by the way, federal government debt to GDP is worse. It's 230% in Japan, and United Kingdom is approximately 130% of GDP. So the leverage in the system is so orders of magnitude worse than what we've ever seen in financial system history. This system essentially cannot withstand 150 basis point yield curve inversion for too much longer. We can get into, if you'd like to discuss the projected Treasury deficit in the US that was released on October 31st. We could discuss that as well if you'd like. But if you have any questions, please.
Sure. Maybe first question would be like, who's taking on all of this leverage? Are these really the financial institutions in terms of like the retirement systems, the social pension funds, and so on, or are these, who's generating all of this leverage in this area? I think it was like now 4 decades, right, of very low interest rates.
So you've got Treasury and the Fed. Fed's balance sheet is $8 trillion versus it was below $1 trillion before the Great Financial Crisis. And that's almost tripled since the beginning of COVID. So you certainly have on a government level, you certainly have a cost to finance that. So the average yield of the treasuries that are floating around the planet, and there's approximately approximately 22 trillion of debt outstanding. The median yield on those obligations is approximately 2.2% today. But the problem is, and 35% of those obligations mature in the next 3 years. So with Fed funds, not even Fed funds today, but the Fed fund futures curve, what is priced for May of 2023 is at approximately 5%. So if you need to refinance 35% of your sovereign obligations at a yield that is double, the implications on this going forward treasury deficit. So we understand that debt is a problem, but now you have additions to the debt. The deficit now begins to exponentially increase as projected refinancing costs that are certainly a proxy for Fed funds is now more than double. So how does that work? Another issue, a significant issue, as I alluded to before, was the projection for this deficit that was released by the Treasury Department on October 31st, and that was a significant second canary in this coal mine. The first being the United Kingdom public and private pension plan system stresses. But that projection was now 2.7 trillion US. The problem that my team and I have figured out is not necessarily the projection that was released on the 31st of October. It's understanding that's based on a projection of a 1.5% real GDP growth in 2023. That's probably adding, in the event of a slowdown or a recession, where in the typical recession, the average of the last two recessions in the U.S., tax receipts, which is the revenue. There's two components of calculating the deficit: simply revenue, tax collections, and expenses. So if we have a recession and the average drop in tax receipts is 35%, well, then that doubles your deficit. And then a lot of work that we've done on the second quarter, which contains the month of April. So in the US, April is tax season, where any underpayment of your obligation is due on April 15th, typically. So there's a very interesting, unique, never before observed unicorn that occurred in 2022 April tax period. So all businesses and all individual taxpayers, the estimated tax system, the way it works is you don't pay. So if you're in 2022, you don't pay as a corporation, for example, or an individual investor. Let's say they experienced in 2021 significant capital gains, or if they were employed for technology businesses that compensated in stock-based compensation. The option grants are taxed at ordinary income rates. So what that caused in 2022 was significant underpayment of 2021's taxable obligations, most of which was because of the significant appreciation of income-producing assets, stocks and stock options as for employees. So they're essentially, my point is, in April of 2022, there was an outsized additional 600 billion of tax receipts to Treasury from this underpayment of 2021's tax obligations from the significant appreciation. It's referred to as, many refer to it as 2021's everything bubble. So that 600 billion in receipts in 2022, the legislation, the tax code, the IRS tax code in the US, mandates the following year, when in terms of estimated tax, to pay 100% of the prior year's obligation. So throughout 2022, throughout 2022, the estimated tax collections, okay, as we said, was outsized an additional 600 billion. Now in 2023, it's going to be reversed. So instead of an outsized increase in tax receipts of 600 billion, now you have taxpayers paying their estimated based on last year's capital gains, which you're not experiencing in 2022. In fact, you're perhaps experiencing losses. So now, instead of that, the Treasury receiving an additional 600 billion, they're going to actually have to refund approximately 600 billion. So that's a delta of 1.2 trillion. So now you've got the Treasury issuing a release on October 31st, projecting a 1.5% real GDP increase in 2023, along with a $2.7 trillion annualized deficit. And it's not including this 1.2 trillion delta, which brings it up to 3.9 trillion, and a 35% reduction in payroll tax receipts in a recession, which adds another 2.5 trillion. And now you're upwards of $5.5 trillion, perhaps, in a recession. So now it's the concept of, in a financialized system where debt is such a significant component of GDP growth on the margin, as the debt builds up, you need more of it in order to produce, you need more than $1 to produce $1 of GDP. So in a recession, everything's pro-cyclical. So now your tax receipts are down. Now your obligations as your obligations to make up for that income loss. So now your organic deficit is up because now your unemployment payments to workers that have lost their jobs. Now that pro-cyclically increases. So this could get really bad, really. And based upon the work we do, we think after January 1st, after the holidays in the US, you're going to see tens of thousands of layoffs in private technology companies. And the numbers regarding public companies, and we've done some work, and we think it's going to be in the hundreds of thousands of layoffs in publicly traded technology companies. And we think the example, and we think it's an example, a good example, set by Elon Musk with essentially getting rid of 2/3 of Twitter's employees and not threatening the Twitter business. In fact, we've got access to some real-time data providers, Data.io and SimilarWeb, and we track the user engagement of Twitter since Elon's closing, and engagement's up 30% year over year. So their business, at least what's their business? They sell advertising to eyeballs. So the eyeballs are up 30% in time spent. And yeah, perhaps the advertisers have temporarily dialed down their spending on Twitter. But listen, this has happened before. During COVID, Meta's properties, Facebook, Instagram, and Twitter temporarily had brand advertisers leave because they were concerned with their brand's association with some controversial time there on Twitter during the early parts of COVID. So advertisers want eyeballs, and if it's not brand advertising, we think it'll be a significant transition to performance advertising, which is a lot less susceptible to brand decay.
Let me try and summarize a little bit what you said. So to my basic understanding here, what you're saying is that the US is currently in a sort of unsustainable situation given the latest very fast rate hikes that essentially, it's in a situation where they're just to service the debt. It's becoming an issue and possibly quite soon because of the possibly coming, it really looks like it, a coming recession, right? And so that's, taking the debt part is like one part of the leverage, right, in the system, if I understand it correctly. Do you also see something on the other hand, like in the markets and stock markets with like options and derivatives and so on? Like, is there also a systemic issue in your view, like this? I mean, now looking forward, like where is this all heading? Do you see like kind of a collapse coming because of that, or what do you think, for example, the Fed has to do about this, or what is the most likely outcome going forward, 2023 and beyond, in your views?
Well, I think you hit the nail right on the head. There is significant off-balance sheet obligations in the system. Essentially, these financial weapons of mass destruction, as Warren Buffett famously called derivatives 2 decades ago. You've got today, and this has been publicly documented by the BIS, I believe, the Bank for International Settlements, that there's approximately 600 trillion with a T derivatives outstanding that are basically tied to stable and low interest rates, because most of these derivatives were written over the last 13 years because pension systems and insurance companies were unable to meet their liabilities or obligations as they matured, with the yield curve from 0% overnight for 13 years generally. It's zero. We went up a little bit in 2018, and then we had a 25% S&P drop in 2 weeks in December, and then they quickly pivoted to essentially down to 1.5% by early 2019, and then they slashed them all the way to zero after COVID. That scenario, that paradigm over 13 years, where even getting 10-year, you're getting 1.5%. They weren't able to meet their obligations, and it went for so long that they only had one choice, and it was leverage. We speak to a lot of CIOs at insurance companies and pension plans throughout the developed world, and generally they lever their equity. I'm speaking about insurance companies. They lever their equity between 8 and 10 times in order to get a sufficient yield to meet their maturing obligations. There's an additional issue. Sorry to interrupt. There's just one more thing I wanted to mention. The leverage was specifically in sovereign bonds. They weren't from a regulatory perspective. So for example, in the United States, insurance industry is highly regulated. And essentially there's a capital charge for every dollar of asset that you hold as an insurance company on your balance sheet. That capital charge is significantly lower, almost zero, for sovereign obligations versus corporate bonds, publicly traded equities, private investments, such that they couldn't take the leverage in anything but sovereign obligations. So now you've got the entire pension system in the developed world that's already levered from a government perspective and a corporate perspective and a household perspective. But now you've got your welfare system or your retirement system levered all in the same security, and that is sovereign obligation, which is low interest rates. So now if those low interest rates spike, as they did in the United Kingdom, and there's that fear in the U.S. Janet Yellen famously, well, at least in the macro world, said, I think about 2 months ago, that the Treasury system is facing stresses that are unprecedented. So it's happening here as well. It's just a matter of time. So essentially, it's all pro-cyclical. The system stress increases exponentially as, let's call it, the 10-year yield in the U.S. increases. And how does that work when Fed fund futures are above 5% today and the 10 years at 3.5%? That's 150 basis point inversion, the likes we've never seen, notwithstanding a very short period of time in early 1980, when Paul Volcker raised rates 21% at one point on Fed funds. And by the way, very different environment in 1980. A lot of macro investors like to compare this time period to the 70s and early 1980s. This is more like the 1940s. Mm-hmm. Leverage in the system in 1980, federal debt to GDP was 32%. U.S. federal debt to GDP was 32% in that early 1980 time period, 1981 time period. It's 125% today. Corporate debt to GDP, which is 85% today, was, I think, 31%. I can pull the numbers. Give me 1 second, the exact numbers. And household debt to GDP, let's see, in 19 was at 47% U.S. household debt to GDP, versus today at 75%. So, and there were no derivatives. So you didn't have this stress on the retirement system in the country. So this is not. We're not in an environment where Jay Powell can pretend that he can be Paul Volcker. This is not that environment. Certainly could, but we'll have the worst deflationary depression ever, and that's inclusive of the Great Depression in the U.S. So it can happen. It's just a matter of time before there's a massive pivot due to significant reduction in credit creation.
Let's talk about the Fed. Like, do you think they got the memo here in terms of that they are aware of what you have just outlined in terms of what is building up here? Let's say, given what we've learned about the last couple of weeks with the FOMC meeting, we had PPI coming out this week. Next week, there will be another CPI print. Do you think they are aware of the magnitude of the problem that you've described?
That's a great question. So, and Tuesday morning, Eastern Standard Time at 8:30 is the next CPI release for November in the U.S. And we're building, our model suggests that comes in warmer, that comes in lower than consensus. But the big one that we think is going to be significantly below consensus, we have a very pretty convicted in that thesis, just based on real world data. You can kind of model. It takes a lot of work. There's components, and there's regression analysis and correlation, that because a lot of this real time data does not perfectly reflect the backwards looking data. So it's not a perfect science, but the R squared on that is about 90%. And we think the print in January, I think it's the 13th of January for December, is the big one. That's the time, especially cycling the used car component of core CPI, and also owner's equivalent rent is about 40% of core CPI. We think that's the 12-month comparison, the year-over-year comparison, that shows significant deflation. So it's timing on this. We think it's going to be any day now, any release now. It's a fascinating moment in time.
Yeah, I noticed that the Fed is, of course, usually criticized for using lots of backward-looking data, but in the latest minutes, they also kind of acknowledge, right, that their own approach is basically a bit risky here, and that they might have to look a little bit more into some forward-looking data, as you are doing, and signaling a pause at least. But I think what I got from your recent talk in the Twitter space, you are much more radical here and have kind of a really thought-provoking stance that we actually might be going to negative interest rates in the future, right?
Yeah. I think that's a significant, a non-zero probability, and it depends. It depends on. So, to try to explain what I mean, let's go back to to the fall of 2008, when there was significant stress in the U.S. And I'm sorry that this is kind of a monopoly. I'm monopolizing the discussion regarding the U.S. system. But this, by the way, applies to the European Union as well. But in 2008, late summer, early fall, there were a lot of U.S. commercial banks within the Federal Reserve System that were insolvent. And one by one, even dating back to the previous February of 2007, Bear Stearns was forced into the hands of JP Morgan as an acquisition in order to prevent the risk of a run on the bank. So things were in a really bad position from not only a solvency perspective, but also liquidity perspective, all the way back to the beginning parts of 2007. So now this goes on for a year and a half, and we're standing in September of 2008. And what happens? This is a very significant moment where the FDIC seized Lehman Brothers. That's the technical process of how Lehman went under. It wasn't technically a bankruptcy. Lehman Brothers was seized by the FDIC in the U.S. And because of that, it caused such an unraveling of the system, literally overnight, that not only equity markets, but private equity, every dollar-based asset around the world dropped in value literally overnight. And that demanded significant printing in order to save the system from this pro-cyclical spiral that is orders of magnitude smaller than it is today. So that's why timing of everything is so significant. It's because the longer this charade continues, the more printing ultimately next year will be necessary to save this risk of this spiral, given the ridiculous leverage in the system. Derivatives like this were not written in 05 to 08 because interest rates in 2006 were 5%, and in 2000 you can earn overnight 5.5% for about a year. So insurance companies and pension systems around the planet didn't have to buy these swaps with commercial banks. So there was nothing in existence at that point. And now it's 600 trillion. So the longer they wait, or the longer this plays out, this beginning stages of a deflationary depression, the longer that lasts, and we're not talking years, we're talking weeks, the more money is going to have to be put back in the system to bail it out. So this this dilemma is, in our opinion, one of these data points is going to be so overwhelming. We think it's going to be the CPI print for December, which is released January 13th, I believe. We think that's the moment when the data is so overwhelming, and then including these, in our opinion, massive layoffs that are going to be published in the beginning few weeks of January. That data, and then earnings reports for the fourth quarter, which are going to be a disaster, especially with perhaps announcements of these layoffs waiting until earnings reports, which will start late January, early February. It's just a matter of time, and the longer they wait, the more it's going to cost them. And so now you've got a problem. Okay, so say they print money overnight, and they have to finance a $5 trillion deficit. Well, now you've got a potential banana republic on your hands, because typically, if you're an emerging market and you don't have the currency that's the world's reserve currency, and I believe 82% of world trade is denominated in US dollars today. If you are not that system that is fortunate to have the world's reserve currency, you're an emerging market, and you've got a 25% fiscal deficit, and you've got zero interest rates? No, interest rates don't go down when you're an emerging economy. They skyrocket. So there could be stresses on, U.S. hegemony with regards to what percentage of world trade is denominated in U.S. dollars. So, what's fascinating is some of the announcements that have been released in the last few months from some sovereigns such as Saudi Arabia and what's happening in India. So India, by the way, they're purchasing from Russia, and 50% of their imported oil is denominated in rupees, not U.S. dollars. And so one by one, you've got, let's call them less than ideal friendly U.S. Friendly countries around the world. They're not purchasing energy from Russia in dollars anymore.
Yeah.
And by the way, this conflict in Ukraine, there's a lot of angles to this. It's very complex, but we've got kind of a controversial and perhaps unique perspective on what's really the cause for this conflict in Ukraine. And we think it has everything to do with Russia taking the mantle of the emerging world and saying, guys, when it comes to our export of energy, natural gas to Western Europe, crude oil to India, China, to Turkey, they're essentially saying, we're not taking your dollars. Okay, Germany, if you want to buy Russian energy, we are more than happy to take your euros. But it doesn't make sense to transact when the buyer is not the US and the seller is not the US. Doesn't make any sense to transact in US dollars. We want your euros. And the reason for that is Russia, as I said, is taking the mantle with the emerging world, and they want to de-dollarize global trade. The US accounts for about 22% of world GDP, but only half of that in world trade. Why is 82% denominated in a currency that's not the currency of either party? So that, in our opinion, and certainly that's controversial, but we think the North Star of why Russia entered Ukraine was to begin the process of de-dollarizing global trade. So that's scary when you have a scenario where perhaps in a recession, the US has a 25% deficit. That could potentially motivate more and more countries to halt their usage of dollars to buy foreign energy, especially Russian energy. So yeah, do you have any questions about?
No, that's really a fascinating discussion here. I really like this point because, yeah, it sort of comes together. Like, Putin in some speeches was really also speaking about the fact how the US is just this, financialized system, and it's not real world products. And yeah, of course, with the BRICS, that's kind of interesting. My focus is more usually on China, of course, and I'm somehow not yet seeing like how, let's say, the renminbi or the Chinese yuan will become kind of a second reserve system there. It's quite small still in transactions, although we have some signals now with Xi in Saudi Arabia, right? Those deals are being made in renminbi. So it would kind of be interesting to see, like, what's your thoughts on what could really challenge the US dollar there, and how do you see this? I mean, to me, that is much more longer term view, in contrast to the discussion we just had about the interest rates and how possibly inflation will now be coming down, and like how the economy in the US might be doing short term. I think that will require a very short term action by the Fed, in my point of view. Whereas with this whole context that you just laid out with Russia and possibly the BRICS, that seems to be much further down the road, right? And so, yeah, it's interesting how all of this might take a part and a role. And maybe because you are in the US and you are, very, knowledgeable about the system, what do you think could be kind of a middle ground or a way out of this that from a US perspective, because I mean that must be the most likely outcome. Then the US will always do what is in their interest, right? So what do you think at this point in time, given those short-term things as well as the long-term perspectives that we've just talked about, what would be in the desired outcome for the US, how they can get out of this, and what do you think will happen?
That is a great question, and we've got a unique and controversial response. We think that there is a greater than 25% chance by the end of January 2023 that the U.S. is in a bona fide military conflict with Russia and/or China, and we think the reason there's complexity to hot wars. It's not necessarily always about regime change for democracy purposes. In our opinion, in many instances, military conflict comes down to money. And so the ultimate money dilemma is a threat to the US dollar reserve system that threatens a lot when it comes to US hegemony. And US consumers and citizens, they've got a lot of benefits from the US reserve system. For example, they can print $7 trillion since COVID and not have skyrocketing inflation, because in a slowdown, in a depression, at least on the production side of goods and services, certainly not the consumption, but after the beginning part of 2020, world GDP was down over 15%. And when that happens, in a dollar-based system, your liabilities stay the same. If you're an emerging market, you're Nigeria, and you borrowed from an American bank $10 billion to build infrastructure. Well, that obligation's interest and principal paydown doesn't decrease. But when your economy halts because there's no demand for your oil exports, your revenue decreases dramatically. But your interest payments and principal responsibilities on the $10 billion that you just borrowed from an American institution, that doesn't go away. So then what happens is there's a skyrocketing demand for dollars, just as the Fed is printing $7 trillion to make up the loss in consumer income, which is an enormous benefit that does not exist with any other central bank. So COVID, interestingly, because of its significant increase in dollar demand, because of all of the dollar debt of sovereigns that doesn't decline, but your revenues decline, they needed those dollars. So the Fed printed those dollars, and what happened? The dollar appreciated versus all currencies, not only emerging currencies. So then what implication does that have? Well, your cost of capital, your yield curve, your interest rates don't increase because you don't have pressure selling your treasuries from a declining currency. So that dynamic is singularly unique to the United States because 82% of world trade is denominated in dollars, and call it 2/3 of sovereign and corporate obligations around the world outside the US is denominated in dollars. That's a benefit that we've never seen before. And that's being threatened by this de-dollarization that Russia is taking the mantle with.
But couldn't be a middle ground that the US holds the rates at some medium level for some time, slightly above inflation, and with the aim of reducing the debt itself?
Debt never decreases. um,
because of the way government works. Or
the way the system works.
Mm.
You don't run on a platform in order to be elected to political office anywhere in the West by telling people austerity is the answer. We saw that certainly in Greece with Syriza after what happened in 2012, and you see it in all Western developed economies. So yeah, we don't think that debt is going to decline. It's just a matter of time, really. And what was interesting in World War II, getting back to my comment about a greater than 25% probability of a bona fide military conflict by the end of January. A lot of that has to do with kind of the research we've done about the history of military conflicts in the U.S. And interestingly, what happens during a military conflict? Well, what happened after FDR's declaration of war against the Empire of Japan? They cut interest rates to zero. When inflation leading up, the 11 and a half months leading up in 1941 to the attack on Pearl Harbor, interest rates were about 1%, and inflation, CPI inflation, was measured at 10%. So real interest rates were negative 9% leading up to World War II.
Mm-hmm.
Once the economy had to pivot from a consumer-based economy to a wartime economy, which drove up significant stresses on inflation, leading to 1946, when the economy now had to harken back to now a consumer-based economy, where all this demand from all of the troops coming back and the demands on residential real estate construction. So inflation in 1946 was 20% in the U.S. and interest rates, the 5-year Treasury note was 2.5%. Okay, so real interest rates during and after a war typically are significantly low, negative, and it's because this is just human. Sorry, let me just say this. And the human condition, okay, is when there's a common enemy in a war, okay, your previous notion of paying more for goods and services in a normal peacetime economy changes. You suddenly have a tribal motivation to do everything as a culture and as a society to overcome this common enemy. So the population accepts rampant inflation with zero cost of capital. And we have example after example dating back all the way to the Civil War in the United States and World War I and World War II and the Vietnam War. In times of conflict, when your system is threatened, the population accepts negative real interest rates. And so, from a conspiratorial perspective, perhaps the system may see that as a potential savior for the dollar.
Yeah, I get your argument here, but I'm going to challenge you on this one. I think isn't the more likely outcome with the higher probabilities for 2023 that we actually get peace in the Ukraine? And I'm saying that because that's my European perspective for now. But I think for the US, it's going pretty well currently, given that they don't have a physical engagement in the war over Ukraine. There is a much tighter friendship now in the West between the Western allies. Germany has been cut off from Russian energy. We're importing for much higher prices LNG from, for example, also the US. So I think many things are also going in in a good direction for the US. And we have also to be aware that like a conflict with Russia with an US involvement, like actual troops on the ground, would mean an escalation. And I think Putin is not a guy who's bluffing on this into, let's say, some kind of a nuclear war. So isn't there like higher odds for a way out of this in a peaceful way, also given, let's say, for example, China's role on top of that? They haven't shown any signs of supporting Russia in this regard as well. So I do see your argument here for on the economic side, like that kind of makes sense for me, like this, de-dollarization, and because like from trying to think from their perspective, like if you are Russia, if you are China, what this conflict in Ukraine has really shown is that you need to kind of get independent from the US financial system in a way, because of course, the financial system has been used as a weapon, if you will, in order to, with the sanctions and the SEPA system and stuff like that. So this is quite natural for them, I would say, to hedge their bets also and to diversify in a way. But I don't really see this as a bigger military escalation there, and also not as a necessity, for example, for starting printing again. So I would say rather, that's why I asked you also about this middle ground. Is there a way that we can kind of get out of the situation that we are experiencing, that we have described, in a way that possibly is not, destroying the whole financial system or resulting in a war in a way? Because, and I'm adding my question to this, are like, how would you position yourself for this in the markets? Like, if you're anticipating interest rates going lower because of those many reasons we've described, that would actually be reason to go long, right? But given what else you've described, like the real stress in the system and even the potential of war, that would rather mean like, well, let's get out of here, right?
Yeah, you said it perfectly. It is an incredibly complicated moment, and a lot of different possibilities. So there's one thing I wanted to touch upon, and that's the level of reserves in the United Kingdom and Western Europe and European Union. So, and you can kind of do the math on this. You can just go on Bank of England's website and pull off their reserve position, their reserves position. Now, and that's important. So then, if they have an accelerating import current account deficit due to increased energy importation cost, which is happening in the European Union and the United Kingdom, what that causes is, if you're paying for those imports with currency other than your own, then you have to use your foreign exchange reserves. And if 75% of your reserves are denominated in U.S. assets, primarily treasuries, funding this current account deficit that's accelerating causes a mechanism where you have to sell down your U.S. treasuries to generate U.S. dollars to pay for your current account deficit, which then pressures U.S. long-dated treasury yields, which then stresses the pension systems and the insurance system. So to the extent that this conflict continues, you will most certainly see further stress on the supply of treasuries. So then the question is, who is left to take up all that supply? Because remember, we've got a projected $3 trillion deficit, which could, in our opinion, be a $6 trillion deficit in a mild recession next year. Well, who's going to buy that deficit printing, that treasury production? And if it's not your typical Western European and Japanese and South Korean foreign central bank purchasers, because in fact they're selling. So and then you've got another problem. Now you've got an inverted yield curve where money markets and commercial banks in the U.S. are motivated to park their reserves, their liquidity in overnight repo with the Fed, and get 5% yield versus buying 10-year treasuries that now today yield 3.5%. So you can make more money with no duration risk, with no credit risk overnight. How does that work? So there's just a lot of mechanisms today that are so unique that have never been experienced in Western developed economies, that the longer this conflict goes on, the more selling pressure of US Treasuries will occur. And it's because, for example, the United Kingdom, they've got 3 months of reserves to fund their current account deficit, which has exploded in the last 12 months. In Germany, I think it was August, Germany released their first trade deficit, I believe, since 1991. That's a problem. And that trade deficit is specifically due to the skyrocketing energy import costs regarding this conflict. So, by the way, the entire European Union, they also have 3 months of reserves left to fund this current account deficit. Major problem. So the first quarter of next year, something's going to give, whether it's a bona fide engagement to preserve dollar hegemony, or it's the opposite, a resolution. One of the two must occur. And the implications, to answer your question about the implications to interest rates and perhaps some opportunities, and in our opinion, significant asymmetric opportunities. How do you play this in markets? If one way or the other, U.S. overnight rates must go down. Yeah, we could touch upon that. There are some opportunities out there in the market.
Yeah, let's go in that. So what are you doing with your fund? Let's just, we can talk about Tesla, we can talk about software businesses, we can talk about emerging markets. I'll leave it to you. Like, where do you see opportunity right now?
So we didn't start focusing dramatically on macro for nothing. And the reason is, we were involved in the subprime asymmetric opportunity trade back in 05, 06, 07. And essentially, you could purchase insurance on subprime mortgage tranches of CDOs for, call it 2% per annum premium. And they were AAA. And because the market didn't expect any downgrade of a AAA security, the cost to carry that insurance was extremely low. And what a lot of highly diligent and unique investors, Michael Burry is certainly an example. They saw that the risk of a zero on these tranches was significantly high, and they can pay 2% to place that bet, and perhaps the payoff could be 50 times. And in many cases, a lot of these tranches did go to zero, and the payoff was 50x. So we placed a bet, not in CDS, but shorting notional corporate bonds of monoline insurance companies that insured these securities, and that's how we expressed it, because we didn't have the capacity. You need something that's called an ISDA in order to enter into these credit default swaps, which we weren't. It's a process we just couldn't get it. We couldn't get it until it was too late. So we think today there are bets to place that is very similar to that time period, where you, for a very small premium, because the market thinks this security is AAA, or what we're doing, and we can get into the details, we're not doing it in securities, we're doing it in exchange traded financial derivative options. So there's even more asymmetry today in some of the things that we're doing, where for a very small premium, you can perhaps make 100x your money. So that's kind of on the macro side. Just to answer your question regarding public equities, yeah, if interest rates go down, you want to be in productive assets denominated in dollars. The last place, in our opinion, you want to be right now is in fiat currency, whether it's the US dollar or any fiat currency. We don't necessarily think the impact on the dollar will be worse than the impact on the euro and the pound when all these central banks start pivoting. But we do know that productive assets denominated in fiat currency will appreciate, in our opinion, strong opinion. So yeah, you want to be loaded up on hard to replicate assets that in many cases have been demolished because of these temporary high interest rates.
What about Bitcoin, for example, which should be also bringing some other point into the discussion? It's not a productive asset, of course, but might also benefit as a risk asset from declining rates. And we also have this second worry for a recession, which is an earnings recession, right? Which, for example, makes crypto quite interesting right now. Of course, that's a whole another topic with all what's going on with the deleveraging and the FTX saga and so on. But just as an asset class, what do you think about crypto?
So you may not like my response, but I'll share it with you. So we did a deep dive into Bitcoin specifically about 10 years ago. And we thought it was theoretically a perfect solution to a system that is incredibly unfair, especially regarding the significant increases in the wealth divide all across the planet. What a theoretically perfect solution.
Yeah.
And unfortunately, we thought through the implications on geopolitics and what's essentially what is the primary control mechanism of government? It's the currency, because they control it, they print it, they issue obligations on it, and every citizen is somewhat powerless when they're using that currency as the medium of exchange of goods and services that they need to consume to live. So we thought, to the extent that it was successful as a medium of exchange, not as a store of wealth, but to the extent that it was successful as a medium of exchange, it would render its own demise. And the quicker that process occurred, the more hastened that demise would occur. So in a sense, the higher the value, the more at risk it was for being outlawed, for example. So we, unfortunately, we didn't invest in Bitcoin. We could have made a lot of money.
What if we described the whole issue around the financial system and the USD dollarization? Wouldn't it be a smart approach by the US government to flip their bet on Bitcoin in a way and basically embracing it as a new form of reserve currency? Of course, India has banned it, China has banned it. I mean, there are lots of issues around Bitcoin for sure, but there is a fundamental issue to the US dollar in terms of the debt and the inflation and all of those things that we are currently experiencing, right? And you just pointed out how you also research Bitcoin, and like theoretically, there seems to be some way to calling it sound money, right? And do you see any chance that there could be some lobbying on US politicians in order to maybe work that one into a solution to all of those issues we've discussed?
Wow, that's interesting. So that is a solution. So I'm going to give you an analogous response, and I'm going to use gold as kind of a proxy for Bitcoin.
Yeah.
Anything that it could be an alternative currency, okay, or perhaps in gold's scenario, it historically has always been a currency. Okay, so let's say central banks purchased Bitcoin. They bought it all, and the ratio being their contribution to world GDP. So make it fair, okay? And then they overnight mark their reserve holdings of Bitcoin at 1 million times what the previous day's price was. Well, then you can pay off all of your your fiat currency obligations, because you've just revalued your reserve holdings. And by the way, it's happened many, many, many times throughout monetary history regarding gold reserves. So I believe in Germany, Weimar, sorry, I'm probably mispronouncing that.
Weimar Republic, yeah.
Weimar Republic. That's what was necessary after first printing Deutschmarks and experiencing hyperinflation. The way out of those Deutschmark obligations was in fact that hyperinflation, and revaluing. By hyperinflating your currency, you're essentially, if you're Germany and you own gold and you hyperinflate your currency, well, then your gold appreciates concurrently with that depreciation of your obligations. So hyperinflation has an analogous impact on your debt to GDP if you either destroy the value of your currency or you inflate your reserves that you hold in your vaults. So in many examples throughout monetary history, that process occurred. And what was interesting is, I believe it was about the summer of 2021, and I forget his name, the Dutch central bank the leader, head governor, announced that in response to a question during a press conference in the summer of 2021 regarding gold, and if the Dutch central bank would ever consider selling their gold holdings, the response from the leader of the Dutch central bank was no. In fact, that is potentially a way out of this mess. So, yeah, Bitcoin, if it was accumulated by central banks, that would be critical. They need to own all of it, and then they need to revalue it. That is definitely a possibility. So to the extent that they don't buy it from you and you hold on to it, if that's what central banks use to unravel this mess, yeah, Bitcoin could be explosively higher. But we think it's going to be, well, if that happens, if that's the mechanism out of this, we think it'll be in gold, and only because it is on these central banks' balance sheets currently. They don't have to buy it. And if you look at what foreign central banks are doing over the last year and a half, they have increased their gold reserves net 700 billion positive, versus selling approximately 450 billion net of U.S. Treasuries, which is the majority of their reserve holdings. So we think you've got kind of the writing on the wall what central banks perhaps will do to unravel this leverage mess that they're in. And it could potentially be revaluing gold significantly higher.
Yeah, super interesting. All right, back to public equities, Tesla. So the backdrop is US dollar likely to come down further. Interest rates have to come down. So that should be good for equities. However, we possibly are entering sort of a global recession. So what will weigh stronger on an equity like Tesla, which is selling goods that are highly priced, that depend on interest rates? There will be a lag, for example, for consumer loans, right, for Tesla cars. So where do you see a company like Tesla going? And feel free to also expand on how you got into the company and what is your bigger thoughts on EV in general as a macro investing topic.
Wow, you called out our second largest equity holding with our firm, which is Tesla. And yeah, please go ahead. I thought you were about to say something.
No.
So yeah, Tesla. Yeah, it's a long story. I'll try to keep it as concise as possible. So I knew of Tesla in the early noughts. You know, I think I saw it at its IPO, and I just thought at that time it would be very difficult to scale and profitably scale. So we passed on it, and then the beginning part of 2019, so quite late in the Tesla journey, I personally bought a Model 3, and I bought it for one reason, just for research purposes. I wanted to turn on full self-driving. I think at that time, today it's 15,000 US to purchase full self-driving. Then I think it was 3,000 or maybe 5,000. So I wanted to see the product. I thought that research process would be very valuable to when are you able to, and by the way, we do this with a lot of products, a lot of applications of the software businesses we invest in. We use the products. It's the best way to see in real time the improvement, the R&D, because of the, in Tesla's case, the over-the-air updates. So anyway, bought the car and had a really interesting conversation coincident with purchasing the car with a firm called Worm Capital. Have you heard of Worm Capital?
Sure, yeah.
Brilliant guys over there. Arnie Allison, he's been at it for a very long time. He was on Amazon Web Services very early. Great investor, brilliant thinker and researcher. So I had a conversation with Worm Capital in May of 2019 to discuss Tesla. Because at that time it was an enormous holding, and I believe, I looked at their 13F a few weeks ago. I think it's a very large holding for Worm Capital, and heard Arnie's thesis and wasn't convinced. Mm-hmm. But now in 2022, beyond convinced that Tesla has such a high probability of being the iPhone of the mobility revolution, even greater than the iPhone of the mobility revolution, and that's because we think they're ultimately going to license full self-driving to these legacy OEMs. That I think they're going to realize that when you're solving the most complex real world software application with AI, it's the most difficult science research compute problem in history. And you're not doing it if you're Ford. You're not doing it if you're Toyota. So I think they're all going to one by one capitulate and beg Tesla to license full self-driving when it comes out of beta. And we think what's going to happen is there'll be one of them that does it first to get a head start from a competitive perspective, and then one by one they'll all want to join the party, because none of them are going to sell full self-driving because they don't have the data. They don't have the fleet of millions of automobiles driving around chasing the nines, accumulating these tail events that bring it from 99.9% accurate to 99.9999% accurate. And by the way, if it's 75% accurate, it's better than a human driver. So they don't have that data. And because of that, and they don't have the compute power that Tesla has. Tesla has designed the entire machine learning compute system, the Dojo system, from the chips to the chips in the automobile, to the chips in their data center. They're essentially migrating off the NVIDIA platform because they're designing a better system that can handle better and quicker bandwidth. And that has a lot to do with, they've got 25 transistors on a contiguous sheet of silicon. So whereas NVIDIA's chips are isolated on individual pieces of silicon, and now you're relying on your networking to slow down that latency. Whereas Tesla's got 25 of them, which is magical, like never been done before in the history of compute. So not only does Tesla have the capacity to process much more data in real time, much faster than any other compute system on the planet, they've got millions of machines that are uploading real-time tail events that will solve full self-driving with the implementation of this Dojo system in the first quarter of next year. So we think Full self-driving can get to a point where, and it's not about the politics and the regulations, it's about generating this data that you can present to the regulators, that this system is now, we've got trillions and trillions of hours, not trillions and trillions of minutes, but of data, real world data, and we can prove to you that this is 99.99999% accurate. And listen, if a country wanted to get an advantage economically from the deflation that comes with an autonomous transportation system, well, one by one, a country that wants this advantage will turn on full self-driving to get this economic advantage, where the biggest cost of logistics is the human driver, and the biggest time suck on productivity is sitting in traffic. So if you're a nation, if you're Germany, and you've got this threat to your industrial system from your most important input price to your industrial economy, oil and natural gas increasing in price, threatening from a cost perspective your industrial base. Well, what a tremendous productivity enhancement by having the cheapest logistics on the planet. So yeah, full self-driving could be an unbelievable source of economic value creation the world has ever seen.
I really like how you describe this thesis of Tesla, and it's the exact same thing I see also in a company. That's why I'm invested. How convinced, or like how high would you rate the probabilities of this investment thesis or the potential that you just laid out, given also like some of the more recent setbacks that are creating all of this overhang for Tesla's stock?
Yeah, so markets, what's the Warren Buffett saying? Markets can be irrational longer than we can be, or you can be solvent. Market prices, we've been at this. I've been personally at this for 26 years. I started in 1997, and I've seen an evolution of the investment industry, and just try to be succinct with this. Generally, more and more, a higher and higher percentage of capital that is invested over the last 2.5 decades has gone to it's the institutionalization of investing. So it used to be 30 years ago, you'd have individuals with their own accounts or their own financial advisor making decisions on their investment portfolios, and that was multiplied across 2/3 of the capital of investment capital. And today 98% of the money that is buying and selling securities, determining their prices in the public markets, is controlled by massive institutions that are not, their North Star is not optimizing P&L. Mm-hmm. Their North Star is accumulating as much assets under management as possible, and the managers of these institutions are optimizing, they're minimizing their risk of being fired. And what that leads to is herd mentality and looking at P ratios to determine what the best investments are, regardless of it's a fossil fuel generating company that's not going to exist in 5 years because it has a single digit PE. So because their boards and their investment allocators, they want certainty. Because certainty, you don't get fired if you invest in something certain. If you invest in a 12% cash flow yielding fossil fuel company today, with interest rates where they are and the environment such as it is, if it goes down, you don't get fired. Okay, if you're in charge of a teacher's pension plan in Iowa, you don't get fired if you invest in a fossil fuel business that's generating a 12% free cash flow yield today. But if you invest in, I don't even want to use Tesla because Tesla's got a 25 P ratio, by the way. But if you're investing in some of the stuff that we do, we invest in software as a service businesses that are intentionally under earning
Mm-hmm.
because the opportunity set is so massive. And let's not even get into gap accounting and how that affects the software earnings inappropriately, in our opinion. But you get fired if you invest in a company that is in growth mode and is intentionally under monetizing their audience or their products, and they're over investing in sales and marketing and research and development to build out their addressable market, and it's extremely difficult to onboard an enterprise software customer. It's significant investment in terms of not only selling but integrating systems. Very expensive to capex. The capex of a software business is not building a factory; it's growing your customer base. And from a gap accounting perspective, that's fully expensed. So these companies are intentionally under earning and intentionally growing, which is temporarily reflecting, in many cases, a negative gap earnings profit profile. Well, you get fired if you're an institution owning these companies. And I agree. I think Tesla is in that bucket as well. Even though, look at Tesla. We expect gap earnings in 2023 will be $7. That's our expectation, forecast for 2023 Tesla gap earnings. So with the price of where it is today, it's 25 times next year's earnings. Mm-hmm. That's without everything that's coming. Full self-driving, scaled reduction in construction costs as they're building the front and the rear CAS, which is going to, with the structural battery, the 4680 battery. We think their manufacturing costs, as they're scaling, as Berlin and as Austin starts ramping up production, we think their gross margins could increase 10% next year, or
even during a recession.
Yes, because in our opinion, their differentiation in the quality of the product and the decreased price. So it's kind of the chicken and the egg. It's kind of this either virtuous or vicious cycle. If, as they're doing, continue to ramp up production, it will in fact lower their cost per unit produced. Mm-hmm. Then will allow them to reduce their cost to the consumer, maintaining their gross margin profile, which, by the way, as you know, is 3 times what the average OEM's gross margin is. So it's a virtuous cycle, in our opinion, where they're going to continue to ramp production to drive down their costs, to then decrease prices to consumers, at the same time maintaining the 35% gross margin. So perhaps in a recession where consumers are looking for more value, and by the way, full self-driving may in fact be turned on sometime, we expect, in the middle of 2023. Now you're getting a driverless automobile, which is the best manufactured machine at perhaps a price even cheaper than the equivalent ICE vehicle. So we think they can actually benefit from a recessionary environment.
Mm-hmm. Super interesting. And regarding Tesla and China, and maybe also going to the broader topic here, also about emerging markets or Chinese equities, how strong do you see Chinese competitors, maybe just on the mainland, not globally, but how far do you think China could be an issue for Tesla in many ways? We talked about geopolitics today. We talked about the competition, of course, and so how do you assess these risks as an investor in Tesla? And then maybe and going more to the final questions here, because we already used up quite a bit of your time, and I appreciate it a lot. But maybe let's end this session here for today, at least, talking more about what's going on in emerging markets in particular.
So in China, we think it's from the data. BYD is the big player. And they certainly are building at scale. Their history is in ICE, and they've made the intelligent decision to pivot dramatically to battery electric, and and non-ICE. However, if you've ever driven a BYD, the quality is significantly, obviously inferior to any model Tesla. And they don't have, their FSD program is non-existent. So it is complicated geopolitically. Tesla is obviously not a Chinese domiciled company, but the Shanghai factory is a tremendous asset to the Chinese economy. And as what we think Tesla is doing is they're going to invest in production capacity to supply local economies and jurisdictions. And so that means, to the extent that Chinese demand increases, they will increase productive capacity. They're not going to import them in China. They will build them in China, which will benefit the Chinese people. So we think, based upon what CCP their policies have been towards foreign companies, it was all about bringing that production onshore into China to satiate the demand for the foreign companies' products, whether it's Nike or Tesla. So they're gonna build more capacity to the extent that consumers make the decision that you're getting a better value with full self-driving and the best machine at the cheapest price. So yeah, we don't really think that's a big threat.
Mm-hmm. Yeah, I'm fully in line with that. I mean, with what you just outlined before, also, it seems to me that the direction of Tesla is going is, forwarding those cost and efficiency gains towards the consumer in order to tap into a larger market, and basically also becoming a larger threat there to BYD, in my point of view, because, as you just outlined, I also would say it's a better product, and more and more at a, let's say, a price tag that is in reach. It's not the same price tag, but I would say people at the lower end, they would then start thinking about, do I want this cheaper car, which has, of course, some drawbacks, or do I make the jump and go on this international brand, which, of course, that's also a trend to discuss. That, of course, Chinese also are going more and more supporting their own products. However, international products are still well sought after. And I think you see always with Apple, they are doing tremendously well in China. And you could argue the same. There has been lots of local competitions coming into the market, and still they're doing phenomenal after years and years. And so, yeah, that's kind of my view, just to add it onto your opinion there, where things are going for Tesla in China. But all right. So last question before we wrap things up, but then onto, let's say, Chinese market, equities, and emerging markets in general. We talked about possibly dollar trend reversing here. We've seen a little bit of a bottoming out in a HSI, and so do you touch any Chinese equities right now, or did you get your fingers too much burned in the recent drawdown along with other risk assets?
Yeah, so it's been interesting, since February, or early March, the conflict, the beginning parts of the conflict in Ukraine, the implications regarding emerging markets, and specifically, Russian equities. We have some Russian exposure to Russian ADRs that are listed in the U.S.
And now you can't trade them, right?
And trade them, and well, the big thing was, prior to the halting of the securities, they went down generally 95% in the matter of days. We own some shares in Sberbank, traded in London, and the thing dropped 99%. With the sanctions, the financial system sanctions on banks, commercial banks in Russia. So, and then what happened? I'm sure you remember what happened. Coincident with that, in the first 2 weeks of March, Chinese ADRs went down dramatically, and they bounced back significantly because what we've seen is one by one over the last, call it 5 years, one by one, institutional investors in the West, the United States, and also Western Europe, one by one, large institutional investors basically got out of their Chinese holdings, and then finally, the last remaining early part of this year, 2022, the last remaining institutional investors got out after the invasion. The conflict began in Ukraine. I don't want to call it an invasion, the conflict that began in Ukraine. So fascinatingly, China has outperformed dramatically. You just look at KWEB's performance, versus NASDAQ or Tesla or the S&P. So isn't that ironic, getting the West completely out, and then whoever was convicted enough, like yourself and like us, we knew these businesses. We knew, the fact that they're domiciled in Cayman Islands, and you're not technically an owner of the businesses. We never thought that was a big threat to the ownership of these fractional ownership of these businesses as investors. Our largest Chinese investment, a company called Beka. Mm-hmm. Symbol is BEKE. It's kind of the Zillow, even bigger than it's a platform, a residential real estate buying and selling platform that has dominant market share in China, where you can go on an app and purchase a home in China, and the platform is this company Beka, and the thing dropped to $8 temporarily in early March 2022, and now it's, I don't know where it is today. It's very volatile. Maybe it's 16. So it's doubled since then. So you have to have conviction, and you have to trust what you're investing in.
Yeah, that must be a real tough holding. Also exposed to the whole Evergrande situation, right? But I'm not following this ticker closely, but as far as I remember, it bounced back well. So it's interesting to see, and I think maybe this is also something which kind of is a similarity between Tesla and China in a way, because there's always so many horror stories out there, like the famous fear, uncertainty, and doubt in the media, that your arbitrage is really from dissecting all of these stories and going deeper, and I think, as you do, like curating, a couple of people that you're following, and so you're getting like firsthand insights, for example, on Twitter, but maybe also on one-on-ones, like video calls and stuff like that. But certainly, if you're doing your due diligence in this regard, you can really outperform, I think, those institutions that are, as you have mentioned, possibly jumping on later on a bandwagon again if the trend has changed, and then it's more safer for them to get back in. We might see something different, similar for Tesla as well. Like as soon as some of these worries are out of the world again, then for them it's a very attractive PE ratio to go in again, because where do you get the combination of the earnings growth, right? And so similar story might be for China here, but I do know, of course, that especially like from an US perspective, it's really tough to engage with this matter and being involved in it, right? So it's interesting to see like a fund like yours being engaged in that matter as well.
The institutionalization of this game really is an enormous advantage for smaller investors like us, because we don't have to play that game. We don't have to be fearful of being fired by a board of a pension plan or an endowment. If you need to have a little patience, and perhaps Tesla underperforms 50% because the CEO purchased the most controversial freedom of speech platform on the planet, and causes some fears of the deterioration in the brand value of Tesla, given what's happening with Twitter. And ultimately, we don't think it's a long-term concern. It just enabled us to invest in, probably, in our opinion, the most impactful company that we'll ever see. given kind of the problems that Tesla is solving for humanity. So it just gives us a better price point to invest, which ultimately will be beneficial. So investing is tough, and in the short-termism that is so pervasive today, just in our society as a whole, and certainly in investing, you can't be levered. So that's the key. You don't want the gain to be turned off. But if you're not levered, then you just get cheaper prices. So it's a long-term benefit. So it's an interesting time, a fascinating time.
Well, Michael, thank you so much. I think that was a perfect closing word. And we could go a lot deeper into individual names like Tesla, or all the discussions we had around the global economics and let's say Chinese equities and stuff. I would really love to do that maybe for another session, but I think today was already very insightful and valuable for our viewers. So I thank you a lot for quite a substantial time that we've taken from you. Thank you so much. And let's do this again.
No, please don't apologize. It's been a great experience being with you on your channel. A very loyal subscriber. I can't thank you enough for allowing me to join you on this great platform.
Cool. Yeah, thank you so much. And as I said, let's do this again. I think it's very valuable for our viewers.